Folks, do you remember Jerome Powell's Jackson Hole meeting? Apparently, he wrote up this big, long speech and he threw it away the night before and he came out with 8 minutes basically saying, I'm coming for you. I actually think he said he's coming for the billionaires. He basically said, I'm going to kill the Fed put. You all on Wall Street have beaten up the Fed and we've bent over when you whined and cried. I believe he's out to beat the Fed put. But you know what? It's going to get hard. The last 9 months or so, it's been easy. It always gets hardest near the end. So, Anna, we got to talk about the Fed put. Do you think Jerome Powell is going to have the backbone to keep it higher for longer? What do you think's going on?
Yeah, it's interesting. I think that he wants to have a legacy of being a Paul Volcker that came to the rescue, not an Arthur Burns that led up too easily, too fast. And so
Yep.
I think he's made it clear. I think he's told us since, for almost a year and a half now, we made a mistake, kind of, right? Inflation wasn't transitory, and we have to beat it. And our number one goal is to get inflation back down to 2%. They've said it over and over again. The markets played, we don't believe you. We think you're crying wolf, and they just continue to rally. And as the markets rally, Jerome Powell says, you're making our job tougher. We're going to go higher for longer until we see substantial decrease of inflation, substantially on the path to get us back to 2%. I think that if he executed a true Fed put at this point, the Fed would lose all credibility that they have left. His job right now is to say, the Fed has this under control. We have a dual mandate. We have to balance price stability. We have to balance employment. We're going to continue to do the hard work as long as it takes. Now, the interesting thing is, I would almost consider what they did with the bank bailouts as a Fed put. It was very specific to one industry, right? So you have 3 banks falling and they had to stop a run. And so they created something new. They go through extraordinary measures to say, we're going to create a liquidity facility again, because part of their job is to be the bank of last resort when there's a banking crisis. And we're going to give you the full value of all of the securities you have on hold to maturity, despite the fact that we know they're worth less. So to me, that was it was a backdoor quantitative easing at the same time that they're quantitative tightening. So I think when you look back at the legacy, some people will say that was the Fed put. They're just not calling it that. I think unless something really breaks in the credit markets and the banking system, which they're worried about,
Oh, yeah.
he continues to go hard and fast. And he at least says, I told you I was going to keep raising. I want to get our neutral rate to, 4.5%, 5%. That keeps going up. And I'm going to hold. And so I think he's still going to raise another 25 bips in May. I think he's then got the credibility to say, we told you we were going there. We are going after this. Now we're going to pause and watch the data. And if something breaks badly, then he can come in later and say, we didn't really do a pivot. We kept with what we wanted to do, and we're going to hold it there. But if something breaks, we'll be the hero and come in and rescue it after we're done trying to attempt to kill inflation. That's my thought.
It's funny. We're in sync. I think we get our last and final Fed rate bump on May 3rd. That takes us to a 5 to 5.25, which, they'll call it 5.12. And then he holds. I think he's going to hold on tight for at least the rest of the year. And I think his goal, if you gave him truth serum, would be through Q1.
You've joined me. I'm gonna just jab and tease a little bit because it's funny because we've both been through this. So we've been right calling things in advance, but you thought they would pivot this year. And I keep saying, I don't think they're gonna do it. I think they're gonna wait till next year. So I think I'm kind of pulling you over to my side on they're gonna wait. But again, it depends on if something breaks, as to whether we're right or wrong.
No, yeah. And again, I think if there's something breaks, it's going to be what? Because again, I think one of the things that Powell's trying to do, looking back at Silicon Valley Bank, Signature Bank, is I think what he's basically saying is, hey, Treasury, FDIC, that's your job. I'm a team member, but that's not me, right? Because again, we really do have a trilemma, not a dilemma. Full employment,
right?
Stable prices, and a stable financial system.
Yes.
And I think right now it's that last one. I don't know if you've seen First Republic Bank, but they're down another 30% today after 50% yesterday. That bank is dead. But the
Right.
problem is I don't think the FDIC can take it over, right? I think the balance sheet hole is so big. They're like,
Right.
maybe we just have to let this thing, you know, live for a little while. So it's pretty
Absolutely.
wild.
It's crazy, and I've studied a lot. I mean, I have volumes on the history of the Fed and why they made decisions from all the way back to the Great Depression and what they did right and what they did wrong. And what's really interesting is although we have this time period where everybody's comparing it to the 1970s, and it's a lot like that in some ways, our debt, our national debt is substantially greater than it was then. And so it just can't handle the level of rapid rate increases that we had back then without potentially more pain. And so the Fed realizes that this is about more than just inflation. This is about more than just the stock market. When you start to have things break in the credit market and the banking system, it really creates fear at a level they've never experienced. In this digital social media age, when everybody's on Twitter going, the bank's going to fail, pull your money out, and then,
Yeah.
everybody pulls their money
Yeah.
out.
$100 billion in 24 hours. That's a bank
You're
run
in a
by.
real time media where panic can be, spread much more rapidly than it did before. And so, there's this real challenge between Powell trying to, get prices stable and keep unemployment at a certain level. Yellen and the Treasury's basically trying to make sure that there's not fear in the banking system, that they can assure everybody that everything's safe and that they have all the tools they need to make sure that, you're going to get your money back at some point. And then you've got the federal government with fiscal policy that has to make decisions about taxation and debt ceilings and, budgets, and all these things really work together with the complexity of our financial system. There's definitely potentially much more pain than I think what the markets are estimating that are hoping for just this quick Fed put. So, your guess is as good as mine in terms of where it goes. But I do think that the Fed has to do their job. Powell's job, number one right now, is get inflation down. And I think that he is not going to stop until he does everything in his power to at least say, hey, as much as it depended on us, we stayed the course. And if something breaks, just like it did, with SVP and Republic Bank, we'll bring in the Treasury, we'll bring in Congress, we'll work together and figure it all out.
Yeah.
But in my estimation, there's no way they pivot unless we have a deep crisis. And where I think we're most likely to potentially experience that really is in the credit markets and the small banks. Banks have
Yeah.
lost significant deposits, and they're finally starting to say the small banks are now offering 4 to 5% in high yield savings accounts and money
Yeah.
markets. I've moved a little bit of my money because I had more than I wanted and I wanted to get better,
Yeah.
yields. The big banks haven't raised their deposit rates, despite, them making more. And so, I think small banks are stressed. And I can tell you, as someone that does commercial real estate, the lending markets are extremely tight, faster and tighter than I anticipated they would be. Low LTV banks are not lending. They're having to hold more money on the books and reserves because of all these hold to maturity
Mhm.
bonds and especially large commercial real estate loans. I think there's still more pain and risk there. And if that bubble pops and if banks start to fail, I think that that's the only thing in my estimation that makes Powell say, okay, we're done, we're pivoting.
Yeah. I want to talk about commercial real estate just a little bit because, again, I think a lot of people look at commercial real estate and they automatically go back to what happened in residential. Um, the debt structure and equity structure is very different, as you know, but let's bring the audience up, right? Back in '06, the last horrible vintage of those toxic loans, I think the average LTV was like 95 or 96%, with some loans being 103%. That's not typically
Yes.
what you have in commercial, right? Commercial, even a very high LTV would be 80%, many at 75 and some at 70. So again, why I bring that up is there is equity that will be wiped out first before the bank takes a haircut. And I think we talked about that Houston deal where
Yes.
LPs lost 100 million and the bank took a 14% haircut. So not like the banks won't feel pain, but the equity feels the pain first. So can you just highlight, what that means and why that may dampen some of the bank pain?
Yes, and I think we should probably do another deeper dive on the show maybe for next week to really dive into this. But essentially when things are going really well, banks and bridge lenders, these temporary financing, just like adjustable rate mortgage, 3-year arms were back in 2006 and 7.
Yep.
Now we've got these bridge loans, and basically prices went so high in commercial real estate over the last 2 years with so much money chasing yield and chasing deals that it was really easy to get loans. And if you have the holy grail, like in multifamily, you can get Fannie and Freddie finance for 75 to 80% LTV, depending on the market you're in. And so, you have a $100 million deal, you get an $80 million loan, best case scenario, and you might have a fixed period or you might have an adjustable rate period. If you had a great loan like that and you have an adjustable rate period, then at the end of your 1 or 2 years of, fixed rate, all of a sudden now you're having to pay a higher interest rate that's double literally since what they were a year or two ago. And so because the interest rate goes up, the cost of that debt service goes up. So because your debt is now a bigger percentage of your cash flow, you're left with less cash flow. You may violate the loan covenants and not have a debt service coverage ratio that the banks make you keep. So that increased rate makes them say, wait a second, you're out of whack. We need to get your loan payment back down in order for you to continue to meet these numbers. Or they're trying to refinance the property, and now they thought they could refinance at 75 or 80% LTV like they could, but they can only refinance at 60% loan to value. So now where they thought they could take out 20-25% equity, or at least roll over the loan into a better term, now they're having to actually come to the table, Michael, and pay down that loan a little bit
Yep.
or a lot in order to get that debt payment back under the threshold as a percentage of their income, or to get a new loan at a lower LTV. And so what that does is it reduces equity because now you have a lower value
Yeah.
property, and you're having to pay down money. So sometimes, unfortunately, even really good operators are having to go, wait a second, we need a capital call because now we need to pay down this loan. Or they might have rate caps, like insurance that keeps your rate capped at a certain amount. Those rate caps went from they went up from, for example, 30,000 a year to 300,000 a year. 50,000 a year to 500,000 a year. So that further squeezes the net income and the debt coverage ratio. And what it means is if lenders will not work with the borrowers and they take the properties back, essentially what they owe on the debt could be more than what the property is worth. And all of the equity is wiped out as the lender takes back that property. Multifamily that was done with Fannie and Freddie financing are in much, much better shape. Where the real pain is bridge debt on multi. The bigger pain is really retail and office. There's billions of dollars in retail and office space that are empty. And because the cash flow isn't there, they can't meet their debt service. And if they can't get those spaces filled, it's not going to get better. And so they're just big companies are handing the keys to the bank and saying, we're out. And so every man's debt is another man's asset. So the debt of the mortgage for commercial real estate is the asset of the banks. And so if they have to write down these assets, they can become insolvent if they don't get liquidity and minimize their own debts. And so it's this ripple effect that really has not yet shown itself how big the problem could be, especially in office and retail.
Yeah. Lots of fun stuff. Definitely stuff to watch for. Anna, how can people follow you?
Great. You can find me here every week on social media at Anna Kelly REI Mom and on my website at reimom.com.
Thank you so much.
Thank you.